Good morning, Trinidad and Tobago, and welcome to the Bourse Report. And it's hard to beat that footage that we just saw, but I'll definitely try. Today, we take a look at the recently released performance results of NGL and GHL, two stocks listed on the local stock exchange. At current prices, both GHL and NGL offer investors attractive dividend yields, along with the possibility of some upward movement in share price from positive developments on the horizon. Let's first take a look at NGL. And for the 6-month period ended June 2016, NGL recorded earnings per share of 47 cents, down 16% against the 56 cents earned in the prior period. Share of profits was the main driver of this downward movement, which also decreased in similar fashion, about 16%, attributable to decreased performance from its PPGPL investment. As mentioned, NGL offers a dividend yield of 6.3% to investors, and had recently declared a 50 cents per share dividend payable on September 9th, and the stock will trade ex-div from August 23rd. Taking a look at the production and pricing data which NGL experienced over the last 6 months, we would note that total exports of natural gas liquids fell from about 229 million gallons, down about 25% to just about 170 million gallons. While average market prices of natural gas liquids fell from about 83 cents per gallon to just about 66 cents per gallon. And what we note is that this would have all contributed to a decline in share of profits, as mentioned, from about 56 to 47 cents, and of course, earnings per share decline of about 56 to 47 cents. So what's next for NGL? Well, price of exports and export volumes remain important drivers to the performance of NGL and its investment PPGPL, with operating efficiency being less important given the company's long-standing history of relatively stable operating margins. As we can see, prices of natural gas liquids fell over the last 24 to 30 months, but have now stabilized, with the exception of propane, which has actually improved over the last 6-month period. According to BP Trinidad and Tobago, natural gas production is forecast to increase some 20% in 2017 from about 3,400 million standard cubic feet per day that's the current level to just about 4,200 million standard cubic feet per day, a 20% increase as mentioned. This increase in gas production, all other factors held constant, should bode well for the fortunes of PPGPL and by extension NGL and its shareholders. At the current price of $23.75, NGL is trading at a price earnings multiple of just about 10.3 times, and as mentioned, offering investors a dividend yield of a very healthy 6.3%. On the basis of a resilient and attractive dividend payouts, an implicit or built-in hedge against TT dollar depreciation, and an improving medium-term outlook, Bourse maintains its buy rating on NGL. So let's switch quickly to Guardian, and for the 6-month period ended June 2016, Guardian reported earnings per share of about 70 cents, up 37% from the 51 cents per share recorded in the prior period. Main line items which drove this performance was one, a decline in insurance income, which fell, this would be $38 million, about 12.8%, as well as a sharp increase in investing income by about $115 million, or 32%, from $354 million to $470 million. Guardian offers an equally attractive dividend yield to investors of 4.7%. In terms of revenue diversification, we would note that Trinidad and Tobago remains a key operating jurisdiction for GHL. This could be set to change, however, with NTBJ's recent acquisition of a 29.99% stake in GHL. Post-acquisition, many investors may be anticipating a growth in revenues earned from Jamaica, which currently accounts for just about 18% of revenues. Only time will tell whether synergies can be benefited or realized from this acquisition. Looking ahead, while recession in Trinidad and Tobago may influence results, Guardian is making moves to improve its performance. Firstly, the company is undergoing a change in its investment shifting from shorter-term to longer-term investing, which should boost income from investing activities. Secondly, the increase in claims, which came about due to an increase in fire and motor vehicle claims over the past period, should not occur to the same magnitude in subsequent periods, which should help to bolster insurance activity income. And finally, it remains to be seen whether the NCBG acquisition of GHL will result in synergies to boost activity. Using the approximate acquisition price of about $21 to $22 per share paid by NCBG, which is currently a 50% premium to the market prices, it would appear that NCBG has identified some tangible means of creating additional value from its latest investment. At a multiple of 8.3 times and a dividend yield of 4.7%, GHL would appear to offer very good value to the income-seeking investor who is able to take some level of moderate risk. While dividend yield, valuation, and improvements in investment income are positives, economic conditions in Trinidad and Tobago do warrant some caution in terms of GHL's outlook. And on this basis, Bourse maintains its neutral rating on GHL. That's all for this week's edition. For more information, give us a call at 628-9100, visit our website at bourseinvestment.com, or email us at invest@boursefinancial.com. Have yourselves a great investing week. This has been the Bourse Report.